Energy is at the center of nearly every conversation when talking about everyday life and investing. As we look ahead, what matters most for energy prices, particularly oil, given geopolitical matters from the likes of Venezuela and Iran? And with midterm elections coming up in November, how might affordability impact markets and voters? Lots to discuss with Jay Dobson coming up for you right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us today. I am very excited to be here in the studio with my friend and colleague, Jay Dobson, from the Chief Investment Office. Jay, always a pleasure to see you. Good to have you join us.
Yeah, thanks, Anthony. It's great to be here.
Yeah, listen, it goes without saying, and I said this in the introduction, oil, energy markets, it's been a topic of conversation for a very long time, with the AI story being what it was, especially in 2025. And now, of course, there's a lot of geopolitical concerns that are out there between Venezuela and Iran. So I thought, let's just kind of start from the topic, because it is a topic of discussion. With the changes in Venezuela, let's start there. How do you see that impacting oil markets, oil prices as they stand? Because right now we're looking at WTI crude at around $58 a barrel, which is low compared to where we've been for the last 2 years. So what do you see out there?
Yeah, it's interesting, Anthony. I think the first thing you'd have to say is, as a human being, you hope for a better outcome for the Venezuelan people. But when we talk about oil markets, I'd say the impact is pretty limited. Let's put it into some numbers. Venezuela produces just under about 1 million barrels a day. And though I think you could tweak that up slightly, think another 200,000 barrels a day, the reality is to add a lot more to get back to where they were 25 years ago. 3 million barrels a day would take 7 to 10 years and a tremendous amount of investment. Now, it's also important to keep in mind that 1 million barrels a day compares with global demand that is, over 100 million barrels a day. So it's sort of 1%, and we're talking about, even smaller than 1% potential increase. So I would say the impact is minimal, but what I would also say is let's watch that. A consensus view, which is similar to ours, has emerged very quickly that it's difficult to raise it a lot. So I would say watch that. We'll be hearing over the next couple of weeks from oilfield service companies. It'll be interesting to hear what they have to say. But I'd say generally we still believe the global oil market is modestly oversupplied and will probably remain that way, for the better part of the first half of 2026.
Yeah, and some of the research that I've done before sitting with you, and you look at 2024, Venezuela's oil production was only about 0.8% of the global supply. And again, that was like a year and a half to 2 years ago. So we're not talking about a huge impact currently. What's the dynamic between U.S. and Venezuela in this particular space?
Well, the reality is, Venezuela has been a sanctioned country. They haven't been able to import things, equipment that they needed. So this has really been a long-term trend over the last 25 years that you've seen oil production decline. And the reality is you need a lot of investment. Now, Venezuela does produce very heavy crude that U.S. refineries like. So I think even though production won't go up, you'll probably see a couple 100,000 more barrels of exports coming to the U.S., really offsetting where they'd be going elsewhere. And that will back out a small amount of Canadian imports. But the reality is the U.S. would take as much of that as they can. It's just hard to see it increase a lot given the underinvestment and, quite frankly, dilapidated, condition of those assets.
Right, of course. And that's one of the biggest kind of hurdles that they had, or they have as a country.
Yes.
Again, our thoughts are with the people of
Completely.
Venezuela, and hopefully that everything works out positively in their favor. Beyond Venezuela, though, because the other story that we've seen in the news headlines over the last 2 weeks or so is the ongoing kind of internal conflict in Iran, which is a huge supplier of global oil. How much does this play into what you're thinking about the oil markets and prices, et cetera, Jay?
Yeah, geopolitical risk in the oil markets is always something you want to pay attention to. We talk about Venezuela, even though they're a small producer. They're a producer of oil. Iran is a larger producer. I'd also say the other one, Russia, Ukraine, are areas that we're watching on geopolitical risk. What I think is different this time relative to sort of say the last 3 years, where I think investors saw geopolitical risk as being asymmetric to the upside, that people saw, hey, anything that happens in Ukraine or Russia or Iran is going to lead to less supply and higher prices. I think generally where we are in 2026 right now is, geopolitical risk is more balanced. It's probably more symmetrical, that though we could certainly come up with scenarios that would drive oil prices higher, I'd say peaceful resolution of the Russia-Ukraine war, peaceful resolution of Iranian regime change, and certainly if we continue to see sort of a Venezuela remaining sort of peaceful and this current government in control with the U.S. sort of influence. All three of those are probably modestly bearish for crude. Venezuela, as we talked about, probably least of those, but supply could increase. I'm not sure a lot, but I'd say the perception would be that it's bearish for crude. So I'd say generally we watch geopolitical events. You have to. I'd say the risks are more balanced right now. But again, I think it comes back to fundamentals, and fundamentally we're modestly oversupplied. So I think that's really the important thing for investors to be thinking about right now.
Right. Interestingly, because, and we do have a chart that we can pull up, the price of crude oil, as I said, it's about $58 a barrel. Right now, the national average in the U.S. for gasoline at the pump of unleaded gasoline is about $2.82. Yep. It's interesting, there was a spike on the WTI crude price around the time we saw the Venezuela-Iran conflicts, but it's now kind of dissipated a little bit. And then, we hear a lot, especially as we're in a year of midterm elections coming up in a few months in November. The president and others have talked about this word of affordability. When the average American thinks about affordability, something that does come up is the price of gas, whether they're heating their homes or putting fuel in their cars. How do you see this impacting, the oil industry and even energy prices more significantly as we get closer and closer to the midterm elections?
I think you have to look at it very similar to geopolitical risk, where, as I said, is symmetrical in our view now. I think affordability, quite frankly, is going to put a cap on oil prices, over the next 9 months. Now, I think we have to say out loud, the president has very limited direct control of oil production and, quite frankly, oil prices. But this is also a president who's not been afraid to use the voice and the office of the president to make his views known. And I do think that he would like to see oil prices here or modestly lower. He certainly doesn't want them higher. As you pointed out a moment ago, oil prices and gasoline prices are related, so higher oil prices holding all other things constant would lead to higher gasoline prices, and I don't think you want that. So I think in addition to geopolitical risk being sort of more balanced or asymmetrical, I would argue affordability and the focus on that probably convinces us the odds of a big spike in oil in 2026 is fairly unlikely, and if it does occur, to the point you made earlier, it may find its way up, but very, very quickly de-risk and find its way back down, whether that's the market doing that or the president jawboning it lower.
Right, and it's not the first time we've seen geopolitical headlines that could potentially impact energy markets become part of our everyday conversations. We saw that with Russia and Ukraine, but as you were just talking about with me, even though we expected oil supply to really become reduced, it didn't really during that conflict early on.
Yeah, it's a really, really good point. I would say commodity investors today really are show-me investors. They'll say, I'm worried about supply in whatever region, but they're not going to expect or pay for, bet on a supply disruption.
Right.
They will want to see that occur by and large. And I think that's an important element because we don't see, you could certainly paint, sort of off consensus pictures, but I would say by and large, among those three places, it's unlikely to see a big supply disruption that would last for an extended period of time.
Right, thanks, Jay. And as we're wrapping up, just given all these things and these considerations that we're talking about, and look, there's still a lot of unknown ahead of us, right? That's sort of the constant these days, is that we don't know what's coming a lot of times. But we have the AI, technology that continues to explode, which requires a lot more energy. Electrification being one of them. We've talked about that, you and I, in the past. So what of what we know and what we potentially know that's coming, where should investors be considering putting their money to work? Because that seems to be the real question, is like, how do I invest here when I don't really know what might be coming down the pike?
Yeah, no, it's a great question. So energy, let's take that first. We have a
Yeah.
neutral view of energy. I find it hard to believe that energy prices spike materially in 2026. Certainly it's possible, but if I were a betting man, I'd say, odds are pretty low of that. With that being the case, it's probably hard to get excited about energy stocks right here. We'd love on some break to be able to buy those stocks cheaper, but I'd say, our neutral view, and it's about 3% of the S&P 500, I think that's probably the right place to be. You could populate that with integrated oil companies, maybe natural gas exploration and production companies, pipelines. The place we're excited about, and you were just referencing, is the utility sector, where we're seeing, power demand and things like this growing for AI data centers, reshoring of industrial activity, and electrification. There we think, we should be overweight. We have an attractive view of the utility sector, and I do think that is one where investors should be overweight the roughly 2.5% weighting it is in the S&P 500.
Yeah, and more data centers are expected to be built through the next 5 to 10 years. And these things are massive, acres and acres and acres of land, which requires, how many gigawatts of energy, terawatts. I mean, it's just an unbelievable story that continues to grow. So I know we'll be talking a lot about that over the next few months. Jay, anyway, always good to see you. Thanks for coming by. Great way to break down, I think, a question that a lot of folks have been having lately about what's coming up next and what should we do here. So thank you, Jay Dobson. Good to see you, my friend.
Thanks, Anthony.
Thank you. And for more information and anything that Jay and I talked about today, particularly coming out of our Chief Investment Office here at UBS, visit our Insights website at ubs.com/views. And you can follow UBS on social media platforms like LinkedIn and Facebook, plus our own dedicated channel at UBS Trending on Instagram. So give us a follow there. And as always, if you have any questions about what Jay and I spoke about today, please make sure that you're following up and having a conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon, everybody.